Ford yields 6% and screens cheapest, then it lost $8 billion. Trap? So here's the puzzle. A 120-year-old automaker in everyone's driveway screens as one of the cheapest large caps on the list. A PEG near 0.44, a headline multiple around 6 to 7 times, and a yield that flashed close to 6%. On paper, that reads like a gift. But the same year those numbers describe, Ford posted an $8.2 billion net loss on record revenue of $187 billion. A blue chip this recognizable paying this much shouldn't screen this cheap, unless the earnings the screen divides by are distorted. So which is it? A genuine bargain hiding in plain sight, or a screen quietly flagging a broken year? Reason 1. The cheap multiple is an accounting artifact. That 6 to 7 times only appears on adjusted earnings per share. $2.01 in 2023, $1.84 in 2024, then $1.09 in 2025. On a trailing basis under standard accounting, there is no positive multiple at all. Trailing earnings per share is negative $1.53 because Ford booked that $8.2 billion loss, including an $11.1 billion fourth quarter. Its worst since 2008. The PEG near 0.44 measures growth off that collapsed base. A rebound, not durable expansion. When the screen says cheap, ask cheap against which earnings, the adjusted ones or the ones that actually landed. Reason 2. The yield you screened isn't the yield you get. That near 6% figure only existed because Ford paid a 15-cent special dividend on top of the base in 2025. About 75 cents total. For 2026, the special is gone. What remains is the 60-cent regular dividend, a yield closer to 4.4%. Now, in fairness, that base payout looks safe. Ford guides 2026 adjusted free cash flow to $5 to $6 billion, roughly twice the $2.4 billion the regular dividend costs. So the income isn't broken, but the headline yield that made Ford look cheapest was backward-looking, and it has already been trimmed. Did the screen price the dividend you'll actually receive? Reason 3. The profit engine is narrow and under strain. Ford Pro, the commercial arm, earned $6.8 billion, the real workhorse. Ford Blue, the gas and hybrid business, fell to $3 billion from $5.3. And Model E, the electric unit, lost $4.8 billion, guided to lose another $4 to $4.5 billion in 2026. F-Series trucks are only about 23% of revenue, but well over 70% of profits. Layer on a $19.5 billion EV write-down, 3 canceled models, and a record 153 recalls. One honest caveat. Ford says warranty costs actually fell about $1.5 billion. So the recall count is a reputational scar, not a clean profit hole. Leaning this hard on one truck franchise, is Ford cheap or fairly priced for the risk? Now the other side, the case that 2025 was a one-time reset, not a broken engine. Strip out the $19.5 billion EV charge, and it's largely a non-cash cleanup, not lost operations. Ford guides 2026 adjusted operating profit to $8 to $10 billion, and raised that to $8.5 to $10.5 after a $1.3 billion tariff refund. Management says Model E losses narrow from here toward break-even by 2029. If earnings under standard accounting swing back to solidly positive, and adjusted earnings per share re-expand toward 180, then the forward 9 times multiple was measuring real recovering earnings. And the cheapness the screen flagged was genuine, not a mirage. That's the bull's honest claim. Does the rebound show up in the actual numbers? So what actually settles it? One clean test. 2026 full-year adjusted earnings per share, alongside net income under standard accounting. Bargain confirmed if adjusted earnings per share re-expand to $1.80 or better, back to the 2024 level, with net income solidly positive and the Model E loss holding at $4 billion or less. That's a genuine reset. Value trap confirmed if adjusted earnings per share come in at $1.20 or below for a second straight year, with net income negative or near zero. Same base dividend, a re-rating multiple, and a stabilizing EV loss versus a second lost year. The gap between those two outcomes is the whole thesis. So, back to the gap. Genuine bargain or a profit engine quietly bleeding? The honest verdict is stretched. The 6% yield is really about 4.4 and already trimmed. The 6 to 7 times multiple only lives on adjusted earnings. On the numbers that actually landed, Ford lost $8.2 billion. The low PEG is a rebound off that loss, not proven growth. And the profits that remain lean on one truck franchise while the EV unit bleeds. It isn't broken. Ford Pro is real. The dividend is covered. And the rebound is guided. But the screen's headline cheapness does not survive the audit intact. This is a framework for reading the anomaly, not investment advice. What will you watch, the adjusted number or the one that actually lands?